Okay, let's jump right into this explainer, because right now, as of May 4th, 2026, we are witnessing a massive pivot in the market. It's like we're finally tuning out the loud, chaotic noise of all those geopolitical headlines and zooming way in on the actual structural machinery running the crypto industry.
I mean, $78,000, that is the massive Bitcoin price level staring us down right now. It's a sharp, undeniable move upward that just grabbed everyone's attention and completely flipped the momentum in the markets over the last couple of days.
So, what actually sparked that initial spike? Well, it was the Hormuz rally. When the Strait of Hormuz reopened after the Middle East ceasefire, we got this massive wave of immediate macro relief. With the threat of international escalation cooling off and global shipping routes opening back up, market fears just evaporated, and that triggered a huge risk-on rally, pushing us right up to that 78K level.
Section 1. Washington's new political friction.
But just when traders were gearing up for a pure, unhindered bull run, we essentially hit a brick wall. And that wall is internal U.S. politics, creating what we can call a Fed ceiling. On one hand, you've got Senator Cynthia Lummis openly criticizing Fed Chair Jerome Powell. And on the other hand, you have Powell's actual actions, specifically keeping Bitcoin-friendly Governor Miran off key Federal Reserve Board committees. So pro-crypto voices within the central bank are seemingly being sidelined just as the whole market is desperately looking for a decisive 50 basis point rate cut. It injects a whole new wave of uncertainty right into the core of U.S. monetary policy.
Okay, so why does this matter for you and your portfolio? Basically, political gridlock equals a range-bound market. Even though institutional accumulation is absolutely there, this high-level political fighting in Washington acts like a giant weight. It's exactly why Bitcoin might struggle to decisively turn its recent $78,000 true market mean into a firm, undeniable support level today. The market is hesitating while Washington argues.
Section 2. SEC's parallel regulatory path. See, the Fed isn't the only hurdle here. Over in Congress, there's a huge push to pass the Clarity Act, which includes specific regulatory exemptions for the industry. But, working completely independently, the SEC just stepped in and proposed its own set of parallel crypto fundraising rules. These proposed regulations live entirely outside the exemptions lawmakers are debating right now.
The key takeaway here? By proposing these parallel rules, the SEC is sending a loud and clear message. They intend to maintain strict oversight authority over the industry, regardless of what happens with the Clarity Act in Congress. They are essentially creating their own roadmap, which definitely complicates an already gridlocked legislative process.
Section 3. Global machinery ignoring the gridlock.
While the U.S. is stuck in this political stalemate, the rest of the global ecosystem is essentially putting their heads down and ignoring the gridlock. They are quietly executing and building. And it's happening everywhere all at once. Over in Asia, we're seeing major stablecoin partnerships. Down in New Zealand, there are fundamental shifts in wallet infrastructure. And at the protocol level, networks like Cardano are rolling out a massive critical integrations budget to close the utility gap, while competitors like Solana and XRP expand their cross-chain footprints. The structural pipes of the global industry are literally being upgraded as we speak.
Section 4. Asia's stablecoin bridge expands.
This is a perfect example of building a more resilient global network. Stables and Mansa just entered a massive strategic partnership to bridge the highly fragmented stablecoin infrastructure across Asia. They're trying to unify regional liquidity pools, and by doing this, they're directly challenging the traditional USD-dominated payment rails. It's a huge shift, actually mirroring that Euro stablecoin push the French government has been championing recently.
Section 5. The shift to self-custody.
If we jump down to New Zealand, we see another vital piece of this underlying machinery falling into place. Stacked, which you might remember as Lightning Pay, has officially launched its self-custodial Lightning wallet. Now, this isn't just a regular app update. It's a massive milestone because it represents the last major non-custodial exchange transition in all of New Zealand. But the real catalyst behind this is pretty fascinating. If a bit dark, it reflects a much larger global shift toward user-controlled assets following a scary rise in physical wrench attacks across Europe. It's a harsh, real-world reminder of why this is happening. The sheer demand for personal safety and true ownership is physically forcing the infrastructure away from centralized custody and right back into the hands of the users.
Section 6. Deepening on-chain markets.
Because it's not just retail users shifting their habits. We have to look at where the big money, the high-frequency trading volume is migrating. $360 billion. That is the historical volume processed by a major perpetual DEX that just went live on a brand new blockchain. That number alone totally legitimizes the serious institutional capital that's moving directly into these on-chain environments.
Now, if you're wondering what an experimental Perp DEX is, it's basically a decentralized exchange for perpetual futures contracts. But the game changer here is that they're now running on custom, high-performance layers, like Hyper-EVM or Hyperliquid, that are built specifically for ultra-fast, institutional-grade trading. High-frequency execution is packing its bags, leaving traditional setups behind and moving straight onto custom blockchains.
So, to bring it all together, what are the main takeaways for today? First, we are deeply entrenched in this governance and friction phase. Second, despite all that friction, institutional accumulation remains incredibly high. And third, you really need to watch the Moran effect at the Fed. We have to see if pro-crypto voices can actually survive Powell's committee exclusions. You basically have to weigh this incredible global building phase against the ongoing political gridlock in the US.
Which leaves us with one really provocative question to think about. If global on-chain volume keeps scaling, and protocol revenue continues to grow, will crypto finally decouple from Washington's political gridlock? Will this global machinery simply outgrow the stagnant US political narrative? I think that's the absolutely most important question for the market right now. Thanks for joining me for this explainer, and remember, keep your eyes on the data.